All right, let's get started. So thank you for joining us today. This is Breakfast Briefs, Defending Sales Tax Audits and Offers in Compromise. This is our Breakfast Briefs series, and we've been, just so you know, we have a series of seminars. We cover various legal topics from time to time. I encourage you to visit our YouTube page and our website as well if you want to see other prior Breakfast Briefs seminars, webinars, in addition, podcasts. My name is Ted McGinn. I'm the managing partner at Lavelle Law. Lavelle Law is a full-service law firm with offices in Chicago and Schaumburg. We handle a number of different areas, including sales tax, IRS issues, disputes, and other tax problems. Beyond that, we also handle bankruptcy, both individual and business. In addition to that, commercial litigation, real estate, corporate formations, transactions, and a wide range of other areas. We always provide new clients a free consultation, and we'd be happy to sit down with anybody with if you have a legal question of any nature. So by all means, please visit us at lavellelaw.com and reach out to us if you have any questions. So with that said, let's get started. Today's format, both Josh, Nesser, and myself will be taking a topic, giving a presentation, and then we will open it up for question and answer at the end of each of our presentation. Let me introduce you to Josh Nesser. Josh is a shareholder here at Lavelle Law. He focuses practice on tax disputes and then transactions and a number of different business formation issues. As I said previously, my name is Ted McGinn, and I focus my practice on corporate transactions, IRS tax disputes, bankruptcies, and intellectual property. So at this point, I'm going to turn it over to Josh. Josh, go ahead and take it away.
Thanks, Ted. Like Ted said, I'm Josh Nesser, and I spend a lot of my time here working with clients, both businesses and individuals, to assist them through disputes with the IRS, the Illinois Department of Revenue, the City of Chicago, Cook County, from time to time. The reason we're talking about defending sales tax audits now is because in the last few years, we've seen the state's effort to audit cash businesses in the state of Illinois ramp up extensively. Like I said, a lot of what they're targeting are cash businesses. So mostly what we see are bars, restaurants, gas stations, any kind of business you can think of that deals a lot in cash. The state has been on their industry conducting audits and trying to collect liabilities. What they're generally looking for in these audits is unreported sales. You think of an audit, generally you think of an IRS income tax audit, where they're going to look at your income, but also your deductions. On the sales tax side, there's not so much in the way of deductions, so what they're focusing on is the business's sales and trying to figure out if that business is reporting all of its sales on its sales tax returns, and if not, obviously they're looking to tax those unreported sales. From time to time, for example, we see businesses where they will report all their credit card receipts, but when they get cash, they just put it in the drawer and don't report it. That's something that the state is looking out for and that they've started to catch on to. One thing to keep in mind, a business that is willfully going out of its way to not report cash receipts, that can be a criminal issue. Today, we're just talking about the civil side, and the aim is always to keep things civil rather than moving on to the criminal side, but that's obviously what you want to stay away from, doing anything that can expose you, your business, or anyone else to criminal liability. Now, a lot of people ask, why is the state auditing me? How was I selected? Is it a random thing? It can be random, but a lot of times what we see is that they will get information from suppliers and vendors as to who they're selling their products to, and then they will go out and audit those businesses. So in an audit, they might go to the business and say, okay, where do you purchase your product from? Who's your wholesaler? And then they'll go to that wholesaler and they'll say, okay, we want a list of every business you're selling product to, and then they'll reach out to all those businesses and audit them. So it's kind of this web that they create, going from business to wholesaler down to the business and to their wholesaler, to just find as many of these cash businesses as they can and conduct as many audits as they can in hopes of raising revenue. So the first thing we're going to talk about, and the main thing we're going to talk about, is how does an audit work? What does the audit process look like? Ted, you can move on to the next slide. So the first step is that, and anybody who's gone through an audit has seen this, but the first step is you get a letter in the mail alerting you that the state is going to conduct an audit of your business. And normally that letter will let you know who the auditor is, and it'll give you a laundry list of the books and records that auditor wants you to produce by a certain date. And those books and records are going to be what forms the basis of the audit. They'll ask for things like bank statements, reports from your point of sale system, your general ledger, your purchase invoices, federal income tax returns, anything they can look at to see what money is coming into your business. And the real important one there is the point of sale reports. A lot of times businesses may not have those reports because they didn't keep them long enough, they were destroyed, the old system crashed. And when you don't have those reports, it's a problem because it's going to be tough to prove to the IRS what your sales were. Ted, next slide. So what they're going to do with those books and records is attempt to reconcile them against your sales tax returns. They're going to compare, for instance, your bank statements for the year to what you report on your sales tax returns for the year. They're going to make sure that your federal income tax returns match up with what you reported. And of course, your point of sale system, they're going to make sure those match up. And like I said, it becomes an issue where the books and records aren't available because the way that the sales tax law and audit procedures are written up for the state, if there's no point of sale reports to prove to the state what your business sold, now the state has a little bit of freedom to use some sort of method to estimate what your sales were. So a couple ways they'll go about estimating what your sales were if you can't prove the sales through books and records. One basic way, like I said, they'll look through your bank account, bank statements, and see what was deposited into the bank. And of course, if the deposits into the bank account are higher than what was shown on your sales tax return, their assumption is going to be that there's income that wasn't reported, and it's going to be up to you to prove that that's not the case, which is an uphill battle. One method we see a lot of time in audits is called the markup method. And what happens in that method is the state takes your purchase records, again, the records of what you're buying from your supplier, and your reported cost of goods sold to determine what you purchased during a year or during a specific month. And they will come up with an estimated percentage of how much you mark up what you buy before in order to sell it, and they'll estimate your sales that way. So again, they'll say you bought $100,000 worth of product in this month. We believe that you mark your product up by 100% before you sell it, so we're going to estimate your sales to be 200%. And if any piece of that is wrong, if they're looking at the wrong purchase figures, or if they overestimate your average markup percentage, which they very often do, as you can imagine, your sales are going to look a lot higher than they should, and they're going to try to tax you based on that estimate. And again, it's going to be up to you to prove the state wrong, but without the books and records that actually show what you sold, it's a tough burden to overcome. Ted, next slide. So once they estimate your sales, and you go through the process of trying to disagree with that, sometimes you come to an agreement, sometimes you don't, but eventually they're going to come up with a figure that they think you sold, and they're going to come up with a tax figure that they believe that you owe. So their next step is to issue a proposed notice of tax deficiency. That's not the final step in the audit, but it's kind of their way of saying, okay, we've done our analysis, here's what we found, here's what we think you're going to owe, unless you can prove us wrong. And with that notice, the taxpayer has the right to dispute the findings before something called the informal conference board. And that's kind of an intermediary within the department, sort of like a mediation or arbitration type board, where they will step in, they will hear the taxpayer's case as to why the taxpayer disagrees with the auditor, and they'll try to resolve that by, if they agree with you, asking the auditor to redo their work or look at it from a different angle or something to that effect. Now, you're dealing with somebody within the Department of Revenue, so they're not necessarily taxpayer friendly, but it is a good forum if you think the auditor is not being reasonable or not listening to you. The informal conference board may be able to step in and act somewhat as an advocate between you and the auditor. If whether you do exercise that right or you don't exercise that right, the final step with the auditor is for the auditor to issue a notice of deficiency. That's the final letter from the auditor that says, kind of like the proposed notice, but this one's final, what they found, what they owe. They're going to assess penalties and interest on top of the tax that they assess. So that can obviously make a relatively small liability quickly grow into a bigger one. So something to keep in mind. Now, when you get that notice of deficiency, you have a few options. If you think the numbers are right and it's not really worth fighting anymore, you can agree to it. If you want, you can just ignore it, but that's not really going to get you anywhere because that's more or less the same as agreeing to it because it's going to become final. Or you can request an administrative hearing. Next slide, Ted. If you go through an administrative hearing process, most of the hearings with the Illinois Department of Revenue are handled by a board called the Illinois Independent Tax Tribunal. That was formed a few years ago, and previously, before that, all hearings were actually heard by the Illinois Department of Revenue. So the point of establishing this tax tribunal was to try to get more of an independent review in the hearing process. And from our experience, it has been a good thing. It's not an easy forum to win in, but it's more of a level playing field than it used to be because it is, like I said, independent from the Department of Revenue. Now, within the hearing process, it's sort of like a court proceeding, just less formal. Both parties are represented by an attorney. The matter is heard by an administrative law judge who's going to act by rules of evidence. Each side produces evidence. In a hearing, each side can take testimony. It's a lot like a court proceeding, just a little bit less strict than the state court rules. Most cases, when you go through the hearing process, do result in a settlement, just because the hearing process is long, it's expensive to both sides. So if there is a middle ground, oftentimes the taxpayer and the state's attorney will find it and settle the case. But of course, some do proceed to a hearing. Like I said, if they go to a hearing, that process can take long. The entire process can take a year or more because there's a lot that leads up to the hearing. There's discovery where both sides are producing their evidence. Each side might want to take a deposition. There's a lot of informal conferences with the administrative law judge to let him or her know where things stand and how potential settlement is progressing. By the time you get to an actual hearing, it might take a year or longer, especially now everything with the state is moving extremely slowly. So it's a long, drawn-out process. That's something to know going into it when you figure out how you're going to defend yourself in an audit and how far you're going to take your defense. Next slide, Ted. So when we talk about ways to defend an audit, or actually ways to just prevent an audit in the first place, the best thing that any taxpayer can do, other than obviously reporting all of their income and filing correct sales tax returns, is to keep good books and records. The biggest problem you see with taxpayers is when they get that initial notice from an auditor requesting books and records and they simply don't have them because, like I said, at that point the auditor just kind of has free reign to use all these different methods to estimate what your sales were. And as you can imagine, they're going to overestimate. They're not going to underestimate. Your best defense is to have those books and records so you can prove to the auditor what you sold and that you reported on your sales tax returns was correct. Now, whether you have good books and records or not, it's important throughout the process to keep pressure on the auditor. A lot of times taxpayers are scared of the process. They don't want to upset the auditor. So they really back off and let the auditor do whatever they want and come up with whatever figures they want. And again, the auditor 9 times out of 10 is going to come up with an amount of sales that are more than you think your business sold. So you got to keep pressure on the auditor, make sure you're constantly pushing back to see where the audit is, to see where they're coming with their figures, and don't hesitate to tell them that their calculations are wrong and why. You can always get their manager involved. Sometimes an auditor just is not going to listen to you or isn't being reasonable. So their manager may have a little bit more discretion or just maybe more experience, more willing to listen to you, more willing to step in and help get this resolved. So that's a good move before going to some of these other avenues to try to get the manager involved to see if the manager can help you convince the auditor why what they're doing is wrong. And then it's really important to exercise those appeal rights that we talked about. Getting to the manager, going before the informal conference board, requesting an administrative hearing if it gets to that point. you have a few bites at the apple, and there's no real good reason not to take advantage of those unless you just flat out don't have a case and what they're doing is correct. And the worst they can say is no. Even if you go before the informal conference board and they disagree with you, that's not going to affect you for in the administrative hearing process. So there's no real harm in exercising those appeal rights, and you never know when one of those boards is going to agree with you and knock down your liability a little bit or a lot. And when you're choosing whether to go through an administrative hearing process, again, a lot of people are intimidated by it because it can get expensive, having attorneys involved, it can take a long time. But even cases that aren't that good can reach a settlement if you're just talking about things like penalties or interest. Maybe you'll concede the tax number they're talking about if they'll agree to waive the penalties. And a lot of times they're in favor of settlement just because, again, their attorneys are busy. They don't want to spend a lot of time litigating cases they don't have to if they can wrap them up and get some money in their pocket. So they're willing to give in a little bit. So even if you think there's not much ground to be made up in terms of how much tax you owe, that doesn't always mean the administrative hearing process won't work because there's ways to save money in that process. With that, Ted, we can go on to the next slide and I'll open it up to any questions that anybody might have.
Okay, so we do have some questions. First question, Josh, at what point during the audit should you get your attorney involved, or can you use an accountant for this?
Yeah, a question that we often get too. So to answer the second question first, accountants can help to some degree. A lot of times they're the ones with the books and records in their possession. They might be more familiar with the business. So whether an attorney's involved or not, it's good to have your accountant involved just because they know what's going on. They know the numbers very well, and a lot of times they're very useful in pushing back on the auditor. In terms of getting your attorney involved, we prefer to be in as soon as possible. We think we're most effective if we get in right away, such as when you get that first letter asking for books and records and letting you know that you're under audit. Some people like to leave their accountant as the front man for a little bit, and we're fine with that. There's no bad time to get us involved. A lot of times the accountant will handle the initial audit, and then when they're not getting the answer they want from the auditor, they'll get us involved at that point. Certainly when you're going before the informal conference board or when you're going through an administrative hearing process where you are required by law to have an attorney if you're a business, we would want to be involved at that point because at that point it becomes more of a legal argument, not necessarily just crunching numbers, but explaining why what the department is doing is wrong, is not in accordance with the procedures they have to follow, those kind of things.
Okay, thanks, Josh. And I should have mentioned this before. If you do have a question, you can. There's should be an interface where you can just shoot a question, and we'll take that on and respond with the platform here. Another question we have, Josh. If you go through an administrative hearing process and you're not successful, what are the other options that a taxpayer may have at that point?
At that rate, you do have the right to go to state court, which is just, again, another bite at the apple, another way to apply some pressure to the state if you really think you're not getting the result that you deserve. Again, that's going to be an uphill battle because once the administrative law judge decides against you, the court may be a little bit more tilted towards finding in favor of the state. But if you're talking about a large dollar amount and like I said, you think you're not getting the right answer, that's something you can take advantage of. And then once you come to the end of the audit, even if you're not going to fight it anymore and you owe some money, there are ways to go about trying to resolve that liability, which Ted's going to get into. But just because you're stuck with a number doesn't mean you have to pay that immediately at the end of the audit. There's ways to go about trying to resolve that liability.
Another question, Josh. If you have dealing with sales tax as a result of an audit, there's a liability that's determined. Can the owners of the business be held personally liable for these taxes?
Yeah, that's a really good question. Most people think when they have their corporation, they have their LLC. If the corporation or the LLC owns a debt, the owners cannot be personally responsible for that, which in most cases is true. One of the few exceptions to that is in certain types of taxes, sales taxes, employment taxes, both at the federal and state level, where the business is collecting taxes from a third person, either somebody buying a product or an employee, and they're supposed to pay those over to the government. If they don't pay those over to the government the person within the business who's responsible for making sure those get paid, who's normally going to be the owner, the officers, those kinds of people who run the business, they can be held personally responsible to pay those taxes. So that's another reason you got to be careful with this stuff. If you do it the wrong way, you can end up with a personal liability. There could be criminal issues involved. And another thing to think about, once they figure out that you're underreporting your sales tax or your sales, they're going to go and look at other returns. They're going to say, did you report all of your income? And if not, they're going to audit that return. And if you're a pass-through where the liability falls on the individual owner, they're going to audit your individual tax returns to see if income was underreported. So it's a snowball effect that once they see a problem, they're just going to keep picking at it and assessing as much liability as they can to as many people as possible.
Just to piggyback on that personal liability, Josh, one of the areas or the individuals that they spend a lot of time looking at are those individuals who are signing checks. Those are on the bank account. Those are signing checks. And what I've seen in the past, you know, sometimes maybe a clerk could be just put on the bank account just for convenience, and without realizing it, they're subjecting themselves to personal liability. They may not be calling the shots. They may have an owner who's directing who is paid and where the money is used, but then that clerk is signing all these checks per the direction of the owner. That person could be potentially liable, even though they're not really an owner of the company.
Definitely. It's the state takes a path of least resistance, and the state and the IRS. A lot of times, like you said, the first thing you look at is a check, who signed it. Okay, let's go after them, even though it might not be the right way to do it according to their procedures.
And also, I would add that a personal assessment doesn't mean that the state or the IRS can collect twice. They can only collect the tax amount, whatever that is. And if they collect it from the individual, well, then they're done collecting. If they get it from the company, they're done collecting. They can't collect double the liability.
Right.
One other question, Josh. If a state determines that you've unreported your sales, will they communicate with the IRS and notify them that we have a taxpayer that underreporting their sales?
They definitely can. Most times you see the IRS reporting to the state when something was changed at the federal level, that it also needs to be changed at the state level. But there is that channel the other way. And like I said, once they change the sales tax return for the business, they're going to change the income tax return. And once they change the income tax return to the state level, they definitely can communicate that to the IRS and let them know this is an issue you might want to look at and audit. And that's just another way that this can snowball from a relatively small issue into a much bigger one.
Okay, so why don't we move on to the next topic, that is dealing with offers in compromise. So when we look at an offer in compromise, we're talking about a situation where a taxpayer, there's a liability that's been assessed, and a taxpayer is trying to figure out a way, how can I satisfy or pay that off? We've kind of gone past the contesting the liability, and there's three types of offers and compromises. One is doubt as to collectability, and we will spend most of our time today talking about that, virtually all of our time talking about that, because the overwhelming majority, 95% of the offers that we submit fall under this category. And that's just to summarize what it means is you don't have the ability to pay this liability in full because of lack of your assets. Number two, effective tax administration. This is kind of a relatively new basis to submit an offer in compromise. This comes up where a taxpayer has the ability to pay the liability in full, but due to exceptional circumstances, that taxpayer should not be required to do so. That's kind of an equitable sort of analysis, and the examples that are cited in the Treasury regulations. One example they cite is an individual taxpayer that may be older, may be very ill and sick, and may have an asset. Maybe they have some savings that would enable that taxpayer to pay that liability, but because of the condition of the taxpayer, being old, no future income, and having medical expenses they anticipate, it's inequitable to require that taxpayer to liquidate that savings to pay the tax liability. But I would mention that effective tax administration, it's a rare set of circumstances where the taxpayer would be eligible to submit an offer in that area. So certainly we look at it, but it's just a rare situation. So, and then the third one is doubt as to liability. This is in a situation where the taxpayer has a question or dispute over whether they actually owe the amount that the IRS is trying to collect. Now, again, this is also doesn't happen very often. The reason it doesn't happen very often is the majority of the tax problems that taxpayers come into us with a tax liability, usually it's arising from a situation where a taxpayer has signed a balance due return. They file a return with a balance due on the return, and so in that situation, the taxpayer is essentially agreeing to the liability when they sign that tax return and they file it with the IRS or the Department of Revenue. And in that situation, it's hard to challenge the liability because you signed that return that indicates that balance is due. Now, where we do see these doubt as to liabilities could be in an audit scenario where a taxpayer filed a tax return, the IRS or the Department of Revenue has come in and conducted an audit of some sort, and maybe the taxpayer didn't really have representation during that audit. They were, for whatever reason, were unable to present their position, and the liability was assessed. A liability above and beyond the balance due on the return was assessed. Now, in that situation, you could probably submit an offer based upon doubt as a liability, where you get into the arguments that Josh was kind of getting at as a challenge of liability. But again, usually the offers that we deal with fall under the first category, doubt as a collectability. So when we get into doubt as a collectability offers, the first question that we hear all the time: pennies on the dollar, pennies on the dollar. You see ads in the paper or on TV or on the radio where situations have happened and taxpayers are able to settle a $1 million liability for pennies on the dollar, or even less, $1,000. Does that happen? Does that happen? And the answer is yes, it does happen. It certainly does happen, but not a lot. It does happen a lot. And when you're looking at a doubt as a collectability, the concept behind that whole offer is that you're offering the IRS or the Department of Revenue a settlement amount less than the full balance that's due, but your settlement offer has to be based upon your net worth, the net worth of the taxpayer. And so if you're in a situation where maybe you filed a bankruptcy and there was no assets in that bankruptcy, and then you file an offer in compromise, in that situation, you could submit a very low offer because the bankruptcy court has already determined that you have no assets. So in that situation, you may be eligible for one of those tiny pennies on the dollar offers. But if you do have assets, equity in the home or some other investment account or other ownership of a business, it becomes difficult to get one of those pennies on the dollar offers. So it does happen, but it's your offer is a function of your net worth. So when we look at your offer amount, I mentioned it's there's two components. One would be your equity in your assets. When a taxpayer's you look at a taxpayer, what other assets, what do they own? Typically they're real estate, and if it's a business taxpayer, you got to look at business assets, accounts receivables, maybe equipment, and you get into your net assets. And when I say net assets, it's a couple of steps you have to take. First of all, you need to determine what is the value of these particular assets. And that can be challenging in situations. If you're a business that's operating, you have equipment, you may need to go out and obtain an appraisal of that equipment. If you acquired that equipment recently, then the purchase price becomes kind of relevant in determining what that asset is worth. If it's real estate, for example, your home, you may have to have an appraiser come in. In addition, Zillow or some other websites could be useful as well. But we need to start with determining the value of the assets of the taxpayer. And in those situations where you're dealing with a business taxpayer, and as Josh mentioned earlier, there are certain situations where owners could be found personally liable. If you're in that situation and you're a business taxpayer, you're submitting an offer in compromise, not only do you have to include the value of the business assets, but you also have to include the value of your individual assets, because if you're personally liable, it's fair game for the IRS or the Department of Revenue to seize those assets. Because again, the whole concept between the offer and compromise is the IRS will accept this number if they are convinced that the offer amount equals the reasonable collection potential. In other words, if the IRS took every collection action possible to collect this liability, how much would the IRS get? How much would they be able to raise if they took every action? And that would include levying bank accounts. That would include garnishing wages. That would include seizing accounts receivables. And then if there is an individual that's personally liable, then the IRS or the Department of Revenue would also be able to go after that person individually. So therefore, their assets would also have to be factored into the calculation. So that's that first component is the assets of the taxpayer or any party that the IRS or the Department of Revenue can go after. The next component, monthly income. Okay, so again, the IRS, they have the right to garnish wages or start seizing income or levying bank accounts. So they have a right to go after that stream of income. So what you have to do for this component of the offer, you have to look at the income coming in for that particular taxpayer. And we're talking about income, we're talking about net income. Okay, so remember, if you're a business taxpayer, you need to look at the revenue coming in, and then you subtract the expenses, the ordinary expenses incurred by that business, and that net amount would be that income. If you're talking about an individual, well, now you're looking at that person's wages. What is their monthly wage that they make, whether they're a W-2 wage earner or if they're self-employed? What is that monthly income that taxpayer receives? But then beyond that, you start getting into expenses. Because, the IRS, they certainly acknowledge that a taxpayer, they have a right to, they got to live, okay? So they have to be able to put food on the table for their family, that they're have to be able to pay for their mortgage and the transportation. So when you look at net monthly income, you start with their wage income, and then you subtract their expenses, their necessary expenses, or any expenses related to the health and welfare of the taxpayer or the taxpayer's family. Now, it does get a little bit complicated because, as you can imagine, every taxpayer is different. Some taxpayer may have who lives in, Lincoln Park in Chicago. Well, that housing expense is quite a bit higher than a taxpayer who may live downstate in Champaign, okay? So it's not fair for the IRS to allow that taxpayer living in, Lincoln Park to have a larger expense allowance for their housing utility versus that taxpayer who lives downstate Illinois. So what the IRS does when they start evaluating your monthly income, they will apply certain standards based upon the taxpayer and where the taxpayer lives. And so if a taxpayer, this sometimes becomes a challenge with our clients, is they may have a very high lifestyle, they may have a very nice home, and their monthly expense may exceed the IRS standard. And in that situation, the IRS is not going to say you have to move out. They're not going to say that. But for purposes of determining the minimum offer that taxpayer submits, they're going to ignore those housing and utility expenses that exceed that IRS standard. And so it becomes very difficult in those situations for a taxpayer to be able to pay an offer that's acceptable by the IRS, because again, they're stuck in this situation where they have a high mortgage expense. So that often becomes a challenge when you're trying to do an offer and compromise. All right, so once we have an offer that's been, let me go back a little bit. I forgot to mention this. So when you're submitting an offer and compromise, part of the process is submitting a detailed financial statement with supporting documentation. That's part of the process. You have to show your cards, put all your cards on the table. We deal with, creditors and defendants all the time, and first thing a defendant will say is that they don't have any money, they don't have any assets, they can't pay it off, okay? Well, that's essentially what you're saying to the IRS when you're trying to submit an offer and compromise. However, the IRS is not going to accept at face value that you can't pay in full. They're going to expect that taxpayer to be able to demonstrate to the IRS that they don't have the ability to pay in full. And that includes submitting a detailed financial statement that's going to set forth the taxpayer's income, going to set forth the taxpayer expenses, and your assets. And beyond that, it's not just a financial statement, but you have to be able to substantiate it. Simply showing a financial statement with, low assets, no income, the IRS is going to want to see, they want to see that backed up with documentation. And so when a client comes to us, this is one of the challenges a lot of our clients face, is trying to be organized with their records. And so, when we're talking about substantiation, what you need to be prepared to submit would be, bank statements, proof of your mortgage expense, proof of your healthcare expenses. What are your wages? So we need pay stubs, weekly or biweekly pay stubs. Canceled checks for payments for your car payment, for your home payment. So all that substantiation needs to be gathered and submitted to substantiate the information that's reported on that financial statement. Now, if you got a discrepancy between the financial statement on one hand and your substantiation, the IRS is going to go with the substantiation. That's going to be controlling. Okay. So if you have an offer in compromise that's been submitted, the taxpayer has been able to substantiate, the next question is, how is that payment going to be paid? What are the options for paying off an accepted offer in compromise? Well, you have two choices. One is a monthly payment stream. Okay, under this process is when you submit the offer in compromise, when you file it with the IRS, you submit your first monthly payment. And then at that point, you're going to continue to make those monthly payments while the offer in compromise is being considered by the IRS. And then once it's been accepted, you continue to make those payments over a period of time. If the offer in compromise is ultimately rejected, you don't get a refund of those payments. However, the IRS will apply those payments to the liability that's outstanding and due. Now, a lot of times what happens when you submit an offer in compromise, your offer, it's not going to be accepted, but the IRS will come back with a higher number and you negotiate, and then you may ultimately reach some sort of a compromise. So in that situation, you're going to have to adjust those monthly payments based upon the accepted offer in compromise. Now, option two, that's a lump sum amount, and under that payment option, you're going to submit with the offer in compromise 20% of your offer amount. So if you make a $5,000 offer in compromise, you're going to submit $1,000 down when you submit that offer in compromise. And then while the offer is pending, you're not making any additional payments, but once the offer is accepted, you have to submit the remaining balance of that offer within 5 months. Now, a couple points. When you're doing a installment offer, one thing to understand is that your net income is going to be evaluated for 2 years. So as I said earlier, when the offer amount is determined, you have your net assets, but in addition, you have your present value of your future income. Well, when you're submitting an offer for 24 payments, installment payments, the IRS is going to look at your net income for 2 years. Now, if you're submitting a lump sum offer, a cash offer, they're only going to look at your net income for 1 year. So in other words, you have the opportunity for some savings if you're going to submit that lump sum offer. So keep that in mind. All right, some additional notes to keep in mind when you're considering an offer in compromise. First of all, the offer in compromise is going to take a period of time for the IRS to review the offer. It takes a while for them to get the case assigned to a revenue officer, for them to contact you. They're going to ask for the substantiation. It may take 6 to 8 months. It may take longer than that. The one thing to understand, though, is when you submit an offer in compromise, you're expected to be a perfect taxpayer while that offer is pending, okay, while it's being looked at, but also 5 years after the offer is accepted. And this is sometimes a difficult problem for our clients, is because they submit an offer in compromise, and then while it's pending, they may incur new liabilities that they can't pay. If that happens, the IRS or the Department of Revenue will reject that offer in compromise. Now, you may be able to try to amend it and add the new liabilities to that offer, but sooner or later, the IRS is just going to reject that offer because you cannot incur new liabilities. Part of the goal with the offer in compromise is they want to get taxpayers to be compliant. That's part of the purpose. You know, they want to get taxpayers into the fold, get them compliant like all, you know, like the rest of the taxpayers. And so if you start incurring new liabilities, that's grounds for rejection. In addition, while an offer is pending, the IRS or the Department of Revenue will put a stop of any other collection action. So that's kind of important. That's another good reason to get that offer submitted, because once that's submitted, the IRS or the Department of Revenue will no longer levy bank accounts. They're no longer going to try to harass your customers or garnish wages. They're going to take a step back, and they're going to, allow the offer to run its procedure. They're going to let the taxpayer get his opportunity to submit their offer and compromise and substantiate that. And so that's a good reason. It's a good benefit while you have an offer pending. Also, what about if financial circumstances change after the acceptance? Okay, so keep in mind, an offer and compromise, this is a contract. It's a contract that you're making a proposal to the IRS to settle a liability in full for less than the full amount. If the IRS accepts that, that becomes a contract. It's a contract between you and the IRS or the Department of Revenue. If your financial circumstances change after acceptance, the IRS is still going to accept or expect you to make that payment in order for that liability to be wiped off the books. If you default on that offer and compromise, then at that point, the liability will be reinstated. Any payments you may have made will be applied to the balance due, but the liability is going to be back on the books. Now, it goes the other way too, I might add. Okay, so if you get an offer and compromise, if it is accepted, and the very month after it's accepted, you win the lottery, the IRS can't then come back and say, okay, wait a second, now you have the ability to pay in full, now pay up. They can't do that because you got an accepted offer. So as long as that's, as long as you pay that off in accordance with the terms of the offer, that will be deemed satisfied and paid in full. So it works both ways. All right, so effective tax administration. We talked about that a little bit. Ability to pay the liability in full over time, but due to exceptional circumstances, the taxpayer should not be required to do so. Now, we don't have a whole lot of these offers coming through because the circumstances which with these are accepted are just so narrow, it really doesn't happen. Now, they have some examples in the Treasury regulations, like I mentioned before. If you have a taxpayer, you may have an asset that taxpayer plans on to live off of in their retirement. They have no future income coming in. They may be ill, maybe they are anticipating some medical expenses and they need that asset to satisfy those medical expenses. In that situation, the taxpayer can try to submit an effective tax administration offer, and in that narrow set of circumstances, the IRS will accept that. And even though the taxpayer has an asset where they can pay in full, the IRS will write off the amount because it's inequitable for that taxpayer to pay, because understand, the taxpayer will become destitute if they take that final asset away from that taxpayer. And doubt is a liability. As I mentioned before, again, this doesn't happen very often. A lot of these liabilities and that we see are from situations where the taxpayer signed a return, agreed to the assessment, and in that situation, there's really no basis as to doubt as a liability. Where we do see that doubt as a liability is in the audit scenario, where a taxpayer may not have had an opportunity to challenge an audit, a proposed assessment of an increase in taxes for whatever reason, and in that situation, you may be able to submit an offer based upon doubt as a liability. All right, so we do have a few questions here dealing with offers and compromise. One question that we do have, in dealing with assets for purposes of the offer amount, what happens if only one spouse is liable? That's a very good question. So in that situation, as I mentioned before, you're going to determine what is the net equity of that particular asset of the taxpayer. So if you're dealing with real estate and only you may have a situation where an individual was assessed personally, either for employment taxes or sales taxes, the other spouse is not liable personally. In that situation, the non-liable spouse, the asset that is owned by that non-liable spouse is not factored in the evaluation for purposes of determining the equity of that real estate. So you can slice it in half in that situation. So that's something you want to look at. Very good question. The non-liable portion of that asset is not factored in that equation. So we've got another question here. What about the collection statute? How does an offer in compromise impact the collection statute? So under the law, the IRS and the Department of Revenue, they have a certain period of time with which to collect their taxes. It's typically 10 years from the date of assessment. If you submit an offer in compromise, I mentioned earlier, while the offer is pending, the IRS or the Department of Revenue will cease any collection action while that offer is pending. Now, that is kind of important because that also tolls that collection statute. So if the IRS or the Department of Revenue doesn't collect the tax liability within that collection statute, then they're forever barred from collecting that. But that statute is going to be extended while an offer in compromise is pending. And where that becomes important is if you're nearing the end of that collection statute, one of your strategies may be to not submit an offer in compromise, but try to have that statute run, and that may be a better strategy. Also, and this is kind of beyond the scope of today's presentation, but some of these tax liabilities are dischargeable in bankruptcy, so we need to look at that as well. If you're getting to the point in time where these taxes could be discharged in bankruptcy, you may not want to submit an offer in compromise, because while that offer is pending, that is going to toll that period of time where you can have that tax liability be discharged in a bankruptcy. So that's a factor you need to look at. Okay, another question we have is, again, assets and offer in compromise. What about in business assets, account receivables? How are those valued? That is a very good question. When we're looking at a business taxpayer, there may be balances owed to that business taxpayer. Are those assets that should be considered? And the answer to that question is yes, that's an asset. But it gets more complicated, because what is a true account receivable? So what we do in that situation, we'll look in to see whether or not that is truly a receivable. And it's a receivable only if the taxpayer has done everything that they're obligated to do under that contract. They can't, they're not required to do additional steps, not required to do additional work. They're already done with their project, and that customer owes that taxpayer the money. That's only when you can factor in that receivable for purposes of the offer in compromise. If the taxpayer still has some steps to do, let's say they're in the middle of the project, they got to finish, the roof, they got to finish the sidewalk, whatever the case may be. I would argue that is really not a true receivable at that point in time, and therefore it's really not an asset. So that's a good question to consider. And then the last question here is, what about tax liens? Does the IRS release a tax lien while an offer is pending? And the answer is no. The IRS will not release the lien in that situation. Now, once an offer is submitted, if the offer is accepted, and the taxpayer satisfies that offer in compromise, pays it off, at that point, the IRS will release that lien. But until that point in time, that lien, if it's already been filed, will remain there in place. And so that could be a factor if you're going to try to refinance a mortgage or buy new real estate, buy a car, that lien pops up. Sometimes that can become problematic. There are some steps you can take to try to discharge a particular asset from a tax lien, but that lien will still remain in place until that offer in compromise is accepted and satisfied and paid in full. Josh, we have another question for you. Can you comment about audits and evaluations for independent contractors independent contractors versus employees. Does that come up in your audits?
That does come up from time to time, not necessarily in the course of the sales tax audits, because they don't really look too much at what is being paid to who in terms of employees and independent contractors. But definitely it's an issue that both the state and the IRS will look at. A lot of times it comes up when somebody's being treated as an independent contractor, that relationship terminates and they go and file unemployment and say, I was called a contractor, but really I was an employee. That might trigger the state and then of course the IRS to go back to that business and say, were you treating this person the right way? And if they figure out or they decide that you weren't treating them the right way, that could be a huge issue because a lot of times it's going to impact more than just that one employee. It might impact a whole class of employees. So it's not necessarily a sales tax issue, but definitely something that comes up and something that businesses got to be wary of.
Yeah, in those situations, you're often dealing with the Department of Labor more so than you're dealing with Department of Revenue. So you may get audits in that area as well. Another question on offer and compromises. Are students' 529 plans counted as an asset? Good question. Just so you know, a 529 plan is a savings vehicle for you to put money aside for your children's college tuition. It's kind of an advantageous thing to do because the principal that you add to this 529 account can grow, and that grows tax-free as long as the funds are used for legitimate purposes. So 529 plan, something you see out there, is it an asset for purposes of offer and compromise? Unfortunately, yes, they are an asset that would have to be considered because even though it may be earmarked for your student, your child, it nevertheless is an asset that's owned by the taxpayer. The taxpayer has the ability to tap into it and access it. The IRS has the ability to levy it and seize that account. The IRS will look at that as a luxury in their eyes. And even though I understand, I agree, you have to have your kids go to college. Everybody needs to go to college these days. But college tuition expenses and 529 savings plans, those are viewed as luxuries, and therefore it's an asset that the IRS is going to want to seize, and they're going to want that to be an asset for purposes of determining your reasonable collection potential for an offer and compromise. So I think at that point, we don't really have any other questions. Again, thank everybody for joining us today. I would encourage you to visit us at lavellelaw.com. If you can check out additional podcasts that we have on a wide range of different topics. In addition, you can view prior breakfast briefs that we've had in the past. We also have a YouTube page where you can view some of those breakfast briefs. And as I said before, we're always willing to sit down with new potential clients, provide them a free, no obligation consultation. Certainly, if you have a quick question, you can always send Josh or myself an email. And if you do want to get a copy of this PowerPoint, send us an email. I'll be glad to provide you a copy of that for your records. Once again, thank you for joining us. Have a great rest of your week.